what is an income annuity? What are some of the pros and cons of income annuities? How to leverage them properly, and how to make sure that you're avoiding the most common mistakes if ever trying to leverage an income annuity in the wrong situation. So simply put, an income annuity is a type of insurance product that you could utilize dollars from IRA accounts, so qualified monies. You could utilize Roth IRA monies. You could utilize non-qualified monies, meaning like cash accounts, checking, savings, different things like that. And you're basically placing it into this account that's through an insurance company for the sole purpose of receiving some sort of income stream, either now or in the future, that you cannot outlive. So it really just depends upon an individual situation and depends upon what their goals are throughout retirement. So as an example, when this could be leveraged effectively is, let's say when someone's nearing retirement and they look at what their guaranteed income sources are throughout retirement, maybe they might be receiving some sort of Social Security income that's going to be X amount of dollars. If they're working for a specific employer, maybe that employer might be offering a pension plan, which is a lifetime income stream. That's going to be for some specific dollars. And maybe they're getting, other sorts of income streams, such as like rental income, that they feel confident that that's going to always be there as a supplemental income source, whatever that case might be. But let's just say if we're using this very basic example between Social Security income and pension income, and let's say Social Security income is bringing in 30,000 and pension income is bringing in 30,000, but then after figuring out what this individual's budgeting analysis is, or what their expenses are throughout retirement, they need $80,000 of income to live off of. So out of this $80,000 of expenses every year, they're only sufficing $60,000 between the Social Security income and the pension income. So therefore, now they have to look towards their remaining assets, what their savings are, what their retirement savings are, or their cash savings, and say, okay, how can I suffice this $20,000 gap and make sure that it's done effectively, that if I live to age 80, that income will be coming to me until I'm age 80. If I live to age 120 years old, then that income will still be coming to me until I'm 120 years old. I'm not going to outlive my retirement savings. So it really just comes down to risk. Does that individual want to utilize their assets themselves and create a type of withdrawal strategy? Maybe if that means they're staying within an accumulation phase where they're trying to leverage investments, different stocks, bonds, mutual funds, ETFs, whatever that case might be, and try to take out a percentage each year, hoping that the market's not going to go down, hoping that they created the proper account, they're not overpaying in fees, different things like that. Or do they want to figure out what is the smallest amount of dollars and only as much as necessary, place it in with a type of longevity insurance? And that's what the what the annuities provide, the income from the annuities provide, to say, okay, if I'm taking X amount of dollars, I'm placing it in with an insurance company, they're going to pay me monthly, semi-annual, annual income from now until the day that I pass away, or from now until the day that me and my spouse pass away, as a type of pension type concept. So that's the generic idea of an income annuity, and why somebody would leverage that off of risking their own dollars and just hoping that they're not going to live long enough to outlive those dollars, not live those savings. So it really comes down to annuitization versus income rider. Income riders are fairly new. So these were they came out in the early 2000s. Originally were set up through variable annuities. Then you had fixed annuities and fixed index annuities that started adding them with that suffice some of the problems that variable annuities had when they had this income rider attachment. What's the main difference between these? And I'm going to use some hypothetical examples. Annuitization, this is what used to piss people off, because they would ultimately be giving X amount of dollars to an insurance company, and the insurance company would calculate based upon the actual actuarial data of that individual, okay, we're going to give you X amount of dollars back of income stream that you can never outlive. So as an example, let's say somebody has $100,000 and they gave that to an insurance company through the form of annuitization, and the annuity company said, okay, we're going to pay you back $5,000 every single year to the day you passed away. If, let's say, this person is age 60 and they are thinking, okay, if I'm age 60 right now, I feel like I'm going to live longer than 80. This might make mathematical sense because of, let's say, after the first year they received $5,000, second year they received $5,000, et cetera, et cetera. If you take 100,000 divided by 5,000, that equals 20 years. So if this person, let's say, lived to age 100, they would have only provided the insurance company with 100 grand. They would have received $5,000 every single year. And if they're age 60, if they live to age 100, that's 40 years. They would have received back $200,000 of income. And therefore, every year past that age 80 marker was their nice break-even point where now they're taking from the insurance company's pockets. So that's the generic concept of it. The problem with annuitization is it makes the individual lose control of their monies. They would have surrendered this $100,000 to the insurance company, so therefore they could never reinvest those monies, and they're just waiting year by year for $5,000 of income to come to them every year. Let's say, play devil's advocate, this person didn't live to age 100. Let's say they started at age 60 and they passed away at age 65. In this situation, they would have given up $100,000, would have given up control of $100,000 of their own monies. They would have received $5,000 per year. It would have only lasted 5 years. They would have received a total of $25,000, and then they passed away. So in that example, they gave $100,000 to the insurance company. They were age 60. They only lived for 5 years, meaning they only received back $25,000 worth of monies, and now the $75,000 of the difference, that goes back to the insurance company. So they have all the control. So this person surrendered control for that peace of mind that they would receive lifetime income, but that lifetime income basically fell short. The individual only lived for 5 years in that example. So that's where, individuals were very upset about that concept. And annuitization still exists. You could still, with any sort of annuity contract, they allow annuitization, where you could take it single life only, you could take it joint life income, you could take it like a type of period certain income. But at the end of the day, you're still losing that flexibility. You're still losing control of those monies. And this is why the income rider does suffice that when you're getting set up with the correct company and the correct income rider. Because be mindful, there's a lot of bullshit that's out there with income riders. There's a lot of bullshit that says, okay, this is a guaranteed lifetime withdrawal benefit. This is a guaranteed, roll-up rate on your monies. And it's not a true growth on your physical money. It's just a growth on a calculation account. And I'll explain what I mean in the common mistakes section. But if, let's say, you went with a very, generic hypothetical example, you went with, a company that was giving you lifetime income through the form of an income rider, and same situation, you had $100,000, you got set up with an insurance company that was offering you an annuity with an income rider. Let's say that income rider was paying you, $5,000 of income. You would have given the insurance company, or this account is sitting with the insurance company of $100,000. You're receiving $5,000 per year. And let's just say that there was no gains or losses with the account. Every time you're pulling out the money, $5,000, $5,000, $5,000, it's going to reduce your account value proportionately. So in that example where the individual's age 65 and passes away, let's say if there's $75,000 remaining in the account balance, this $75,000, rather than going back to the insurance company, this will get left over to the beneficiaries. So it's allowing this person to essentially have their cake and eat it too, because in that other situation, let's say if they're receiving $5,000, $5,000, $5,000, and they live to age 100, they would have placed in $100,000. It's spitting off $5,000 every single year. When this account balance hits $0, the insurance company, because there was an income rider attached, that income rider is keeping the income afloat. So that's still allowing this individual to receive $5,000. So therefore, they would have given $100,000 in this contract. Even when they would have exhausted all these monies, let's say by age 80, it didn't make a difference because they were still receiving $5,000 until age 100, and therefore they were able to receive back $200,000 in total in that scenario. It protected the individual if they died too soon, because whatever was remaining in the account balance would get left over as a death benefit, but it also protected them if they lived too long, where if they had a bucket of money and they just had $100,000 and they were trying to pull off $5,000 each year, that bucket of money would have been exhausted by age 80, and then they'd have to go back to work or pull from other assets and sell whatever sort of assets to make sure that they're still receiving that income stream. So this is why, when you're trying to set these up, you just want to be very careful with it, because once again, there's a lot of smoke and mirrors out there. The concept sounds great, but in reality, you have more crap out there than actual good products. Now, some of the good products could be fantastic for an individual situation, and then some products, not so much. So this is why you leverage an income annuity. It's mainly for that longevity insurance, that peace of mind that you want to receive an income stream. You do not want to outlive this income stream. You do not want to try to risk the money in the market. You just want to say, okay, there's going to be a constant paycheck coming to me or me and my spouse every month, every year to the day that we pass away. and that's how it's set up. So it's a type of longevity insurance. Think about that concept. Now, once again, the monies that you could place into this is a large misconception. Individuals think that the only monies that could go into an annuity are cash monies or like checking, savings account type monies. That's not the case. You could set up non-qualified annuities. You could set up Roth IRA annuities. You could set up IRA annuities. So you can set up qualified accounts, non-qualified accounts, Roth accounts, et cetera, to make sure that it's going to suffice what your specific need is, what your specific goal is, and making sure that you're not throwing too much money into this account, but you're throwing the precise amount of money into these accounts. So common mistakes that are made are losing control and flexibility. This is where annuitization really comes into play. Is if you're surrendering all control to the insurance company to just receive a lifetime income stream, why would you do that if you could have been a more effective strategy was leveraging a top income rider related product? So this is where I talk about in a lot of my videos, hybrid annuities. Now, hybrid annuities could be created through variable annuity accounts, which I absolutely hate. Reason being is the income rider is typically not as strong as when you're leveraging a fixed annuity or fixed index annuity with an income rider. On top of it, you have a large amount of fees that they try to hide within the prospectus of the plan. So you might have anywhere between 3% to 5% in annual fees each year, and you could still be subject to downward market losses. So the ones I like to kind of tailor into or typically recommend are right around the fixed index annuity with income rider results, and making sure that it makes mathematical sense from an income play for that situation. So it allows somebody to have control of their monies, to still be able to gain. Their account values could still gain with upward market movements, not lose when the market goes down, and the only thing that's coming out of their account value is the money that they're pulling out. If, let's say, they exhaust all their account balance, then they have the income rider available to still be in force, that's giving them that lifetime income stream. And I'll go over an example off the solutions tab. The next common mistake is using an income annuity for a growth need. So to help you understand this concept, I want to go over how an income rider calculation works. And this is crucial because be mindful, the income benefit base or the calculation account in an income rider is not your physical money. I'm going to repeat that, is not your physical money. So if, let's say, we have company A that has an income rider with a 7% roll-up guarantee versus company B that has an income rider with a 5% roll-up guarantee, the way on how that calculation works, what the amount of income that this person will receive, the cash flow that they will receive, is based upon the income base and the withdrawal rate percentage, and that's what equals the lifetime income. So when you're looking at this and you say company A is giving me a 7% guarantee versus company B is giving me a 5% guarantee, be mindful this is just the calculation account. This is just how the income rider gets generated for lifetime income. So this person is age 60 and they say, okay, well, if I put $100,000 with company A and we're just going to use simple interest, at the end of year one, my income base is going to be 107 versus if I use company B, my income base is going to be 105. Year two, 114 versus 110, et cetera, et cetera. So if this person is age 65 and they want to trigger lifetime income, they're looking at this nice shiny object saying, well, company A, my income base is guaranteed to be $135,000. It's not so fast. The way this formula works, the way the calculation works is by the income base multiplied by the withdrawal rate percentage. Some companies have a higher withdrawal rate percentage and a lower roll-up guarantee, a lower income base. Other companies have a high income base and a high withdrawal rate percentage. In this example, even though 7 looked a lot higher than 5%, when you do the math between the income base and the withdrawal rate percentage, so in this example, $125,000 multiplied by 5%, equals $6,250 versus this one that had a $135,000 income base multiplied by company A only had a withdrawal rate percentage of 4% for a 65-year-old. This would produce only $5,400. So this is equivalent to producing 5.40% cash flow versus 6.250% cash flow. This benefit base is not the physical money. The $100,000 that this person originally put in, this is either getting dinged with a fee, is either gaining with the market based upon what sort of product they chose. So if it's a variable annuity, they could be dinging with fees and downward market loss potential. If it's a fixed index annuity, they could be getting dinged with fees and a 0% growth rate whenever the markets are going down. If it's a fixed account, if it's a fixed annuity with an income rider, they could be getting a fixed rate of return each year. Some companies have income rider fees, some don't have income rider fees. So it really just depends upon your situation and which one you're looking at. But be mindful, this is just the income base. It's not their physical money. The income rider is just used as a calculation account to generate a lifetime income payout, and know that, okay, if you put 200,000 in this example, well, then company A would generate, $10,800 per year versus company B, which would be, what is that, $12,500 per year. So the actual cash flow, understanding what the cash flow amount is crucial with this, but being mindful that you do not get mistaken off of an income base versus what your physical account value money is actually sitting at. So in the example, when it doesn't make any sense to use an income annuity, would be, let's say in that Social Security example, Social Security income, let's say, is giving somebody $30,000 per year of income. Pension income is producing this person another $30,000 a year of income, and then after realizing what the individual's expenses are, maybe they only have $50,000 of expenses in retirement. Well, this retirement expense is going to be sufficed by the income stream, by the cash flow from the Social Security income and the pension income. So why would they put further dollars into an income annuity if they do not have to generate more income? If their expenses, if all their different cost of living and their lifestyle is only going to result in $50,000 per year of income, and they're already sufficing that, what typically happens is an individual will hear from an advisor that would say, oh yeah, place your money in here. We're going to give you that 7% guarantee on your money. And that 7% guarantee is not an actual guarantee. It's just the income base, the calculation percentage. That's where they're using an income annuity for a growth related need. This individual was tricked thinking, oh, I'm getting a 7% rate of return on my money, when that's not the case. It's only on the calculation account. So that's not their true money. Their true money is not gaining by that dollar amount. So I hope that makes sense, because this time and time again, we get these phone calls in the office, and it's a freaking heartbreak, because whatever reason, the advisor did not explain it properly to the individual. The individual didn't want to hear what the advisor was trying to explain. And it comes down to really bad scenarios where the individual could be set up in this account for 3, 5, 7, 10 years, and they think that they have a specific, a dollar amount in their of their money, and that's not the case. So, please be mindful if you have this sort of situation, or you really want to look underneath the hood and get some help on, figuring out what you have or what you're looking about getting set up into. Feel free to call our 1-800 number. It's 1-800-566-1002, and we'll try to help analyze your situation and at least put you on the correct path. And the last common mistake is not leveraging an income annuity when you should be leveraging an income annuity. So this is where somebody, and unfortunately, a lot of individual mindsets are still set up in an accumulation phase. So like with financial planning, you have two main phases. You have a wealth accumulation phase, and then you have a wealth preservation / distribution phase. So when somebody's working, let's say somebody's in their 30s, and they're trying to grow their monies, grow their retirement account, such as a 401k, IRA, Roth 401k, savings, checking, whatever that is, they're trying to accumulate these monies further and further. So the way on how an accumulation account can grow is by the contribution somebody's making into the account, and then the rate of return that's coming back with that specific account. So if they're leveraging investments and they're trying to be super aggressive with investments, some years those investments are going to be positive, some years those investments are going to be negative. But historically, when somebody's trying to leverage the stock market, they're saying, okay, I'm younger now. I'm not going to retire until I'm in my 60s. So I have a nice, 30-year time horizon before I'm actually going to get to this point. Unfortunately, when the individual does get to their 60s, they are still in this wealth accumulation mindset, and they don't try to scale this down into saying, okay, now my account might have started at only a couple of grand, has now grown to $1 million, because they were placing contributions into this plan. They were getting large rates of return, and they were compounding it throughout all those decades. And now this account value is sitting at $1 million. Why would they risk their monies if they don't have to? So this is saying, okay, rather than just leaving these monies to chance and leaving them invested in the market towards a growth strategy, let's scale down and say, if there's a specific income need, leverage a type of income-related strategy, which you can suffice through an income annuity. Use the smallest amount of dollars, only as much as necessary from this $1 million, to set up in that stage for an income play. You're leveraging an insurance company, you're leveraging this type of longevity insurance to produce that lifetime income stream, so that now all of your excess monies, that could be set up for the proper growth-related strategy. So, too often what we'll see is somebody just trying to use a jack of all trades type product. They're trying to leverage leverage a growth-related strategy for an income, a growth, an emergency, a legacy, a tax planning need, and it's shooting themselves in the foot because one downward market hiccup or a couple of downward market hiccups with a bad sequence of return that comes about right when this person retires, that results in a retirement disaster, and that results in somebody outliving their dollars. So I hope that these three common mistakes make sense. A way on how we try to put somebody on the proper trajectory towards a confident retirement is we've trademarked a process. It's known as the retirement diet plan. And the reason why I use that acronym DIET is for very specific reasons. Whenever you're looking at your retirement situation, are you on the correct path to make sure that your distribution income phase is set up correctly? So the DIET, distribution, investment, estate, and taxes. What does your distribution phase look like? What does your investment/growth phase look like? If, let's say, you want to leave a legacy and that's something that's important to you, how do you make sure that that's optimized correctly? And then how do you optimize your tax situation correctly? So in this scenario, I just threw a hypothetical example on the screen. Let's say if somebody has IRA assets or retirement assets of $1 million, this person's age 60, they have Social Security income, they're looking to retire, let's say at age 62, they have Social Security income that will come to them of $30,000. They have pension income that will come to them of $30,000. And then at age 62, we understand that their expenses to sustain their lifestyle throughout retirement is going to be $80,000. Social Security income and pension income is only going to equate to 60 grand. So we have a gap of $20,000 that now needs to be sufficed. Add this $1 million bucket. How do we make sure that everything is spit off or spurt off correctly? So with this, the $1 million, maybe it might require at the top hybrid annuity. So let's say if somebody wants to maintain control and have a lifetime income stream and have a good product or a good, in this example, IRA account, what they could do is take from that $1 million, maybe it might cost them $250,000 to place into an IRA annuity, income annuity with an income rider, and then that will generate the $20,000 that's needed at that age 62. It didn't cost them the full $1 million to risk that money and take the full $1 million and just throw that into an annuity account, which is a common mistake. What they did is they basically crawled before they walked. They walked before they ran. They made sure that the precise dollar amount, not a dollar less, not a dollar more, was placed with this IRA. But it was an IRA annuity that will suffice this $20,000 need. So that has now sufficed their distribution income related need. And now they have $750,000 of excess monies that they could leverage towards an inflationary growth related need, an investment growth related need, whatever that case is. So maybe out of this, they want to leverage some safe accumulation accounts, some bank related products, other insurance related products to make sure that they have some safe accumulation in there. They want to leverage investments, stocks, bonds, ETFs, whatever that case is. And this is what they want to utilize for this investment growth need. So maybe out of this remaining $750,000, they utilize another $300,000 to suffice their investment growth related need based upon what they want to see. If they want to take an extra trip every couple of years and try to pertain and make sure that they're risking their dollars and they're getting good rates of return on that, that has nothing to do with the income related need. So maybe out of this, IRA number 1, this was created an income annuity. IRAs number 2, 3, and 4 was created for a investment growth related need for $300,000. Now based over, from that dollar amount, they use $250,000 in IRA number 1. They use $300,000 in IRAs number 2, 3, and 4, however they want to create that customization. And now they have remaining $450,000 that could be left over for tax related planning or legacy related planning. So maybe they want to leave monies to their grandkids or their kids or their spouse or whatever that is. How to make sure that this is effective. There's an effective strategy there that you could create sort of death benefit arbitrage opportunities. We're utilizing portions, placing it into either you could utilize life insurance policies or just separate accounts that are more tax efficient that could be set up for a type of death benefit inheritance, making sure you are set up with a will, a trust. So these are the different, the different customization that an individual feels confident with at the end of the day with an actual plan, not just a portfolio. And same thing with the taxation. Does it make sense to do Roth conversions versus leaving it into these traditional IRA accounts or, utilize non-qualified monies and an effective tax allocation strategy. So, it's just making sure that you're staying within the acronym of DIET. DIET. Distribution, has your distribution planning been kept up to par? Is that maintained correctly? Do you have a correct solution there? Investment growth need, is there a correct solution there? Estate legacy, and then taxes. So each individual situation is going to be different, but this is what will at least keep you keep you within that correct path to make sure that you're not leaving things to chance, and you have retirement confidence in any market environment. So I hope that all of that made sense. If you found value in this video, you want to speak to a specialist, feel free to call our 1-800 number. It's 1-800-566-1002. Or you could review our website, look at some of our literature, some of our videos. You can set up a calendar appointment directly through our website. And this is FosseFinancial.com or RetireSharp.com. They'll both bring you to the same spot. You schedule a meeting. You'll have a little icon that pops up on your screen to set up a phone appointment, so you can set up a day or time that works best for your situation, and make sure that you're at least it's at least geared to your specific needs, your specific conversation. If that means you want to try to create a budgeting analysis, or you want to speak about different investment growth related strategies, distribution strategies, all of that. But I want to thank you once again for watching this video. Feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. I'm going to try to constantly update these videos to make sure that you could become educated further, and really rely on a topic that pertains to your specific situation. But thanks again, guys, and feel free to reach out to us if you need anything.